subject to deals that have equity. Now, a lot of times when you are uncovering properties that don't have much equity, a subject to deal can be a great exit strategy for the distressed homeowner so that they can move on with their life. You can take over their payments. That's a great acquisition strategy. And if they don't have much equity, they don't have enough money really to be able to pay all of the fees that are associated with selling. They don't have the fees available within their equity to be able to pay for a real estate agent's commissions, things like that. They can't sell traditionally. Well, that's where we have our real estate investor hat on, and we're able to offer them ways that we can be acquiring the property so they can move on with their life. Now, it's important that these people are distressed for a reason. Otherwise, they're not going to be interested in a subject to deal. So usually that means they're going to have some kind of a pre-foreclosure scenario or some kind of an issue that's going on where they can't make their mortgage payments. They need to move fast. So that is one scenario where there's not much equity, that a subject to acquisition strategy where you're buying the property subject to the underlying financing. You're taking over the loan that's in place. The seller's name remains on the loan. You're getting the deed to the property, and then you're the owner of that property, or your company is the owner, and you're moving on with the exit strategy that you think fits best. But what happens when you've got somebody in a situation like that, but they've got some equity and they want something for it? Well, if they're truly distressed, they may be willing to carry back. So it's important, as we're learning about what it is going on in this scenario with the motivated home seller, we're building that rapport, we're building the bridge of trust and relationship so we can start these conversations, find out what it is they really need. So is it a lump sum of money, and what is that they truly need? Or they just need a portion of that because they have to pay off something or to help them move on. They don't need the whole entire amount. So when you start to build that relationship, ask the right questions, you can decide how you want to structure your two offers that includes the solutions that you know are most important to them right now based on their needs. So when you find out exactly what it is they need financially, it could be far less than the amount of equity that is remaining in that property. And of course, we need to build in a profit as well. So if you then have a meeting of the minds where you can come up with some cash to help them with their needs right now, and then be able to have them carry back a note so that you can be making payments or a balloon payment down the way. That way, you're able to get into this deal with as little money as possible, and then also be able to buy that property subject to the underlying financing. And depending on your exit strategy, you might not be coming up with any money at all, especially if you're going to be assigning that contract for a fee. But either way, one thing I wanted to let you know is when you are creating the note in a situation like that, what are the terms that you're going to be putting into this note? Because a lot of times we just naturally think, well, there have to be monthly payments. Well, there needs to be interest. So let's figure out the lowest interest they're willing to take. Well, in actuality, you don't have to have a loan where there are any monthly payments. Or it could be that there are biannual payments or annual payments, and then a lump sum at the end, which is a balloon payment, and then you are giving them the money that is contracted within this carryback financing. But I just want you to know that when you're creating the loan, it's up to you to decide what are the terms of that loan. And in a situation like this, where you want to keep as much money in your pocket as possible, it could be that you're giving them the money right now that they absolutely need. Then you're having them carry back financing, and it could be that you don't owe them any money until the end of that term, depending on how you're structuring that note. It could be that the interest rate is very low, or it could be zero. They just want to get on with their life. You're dealing with somebody that is distressed. They want to get out from underneath this problem. So you're giving them what it is they need, and in return, you're getting favorable terms that you're creating. And again, when you're getting the deed to that property, you can then decide what your exit strategy is. Hopefully you know what that is before you close the deal. If you are assigning that contract for a fee, you're not the one coming out of pocket with anything, but that adds value for that end investor when the terms are good. If you decide to keep that property and have an exit strategy where you are, say, doing a lease with an option to purchase, where somebody's coming up with a lump sum non-refundable option consideration, there's a way that you could be getting some of that money that you're giving to the seller in the first place. Depending on how the numbers work, maybe you're coming out with more money, maybe it's just helping you get the money that you need ultimately repaid back to you as you are giving it to them to first acquire that property. Either way, when you have some choices, when you are acquiring and when you have some choices with your exit strategies, don't forget that when you're creating terms, you can create them as favorably as you can get accepted, as long as it's a win-win for you and the distressed homeowner. I hope that helps. I'll share more with you in the next video.